Welcome to my channel. In this class, I am going to discuss about types of shares, issue of shares, and also the accounting treatment with respect to shares. Shares are mainly of uh, two types according to the section 86 of the Indian Companies Act. That is preference shares and equity shares. Equity shares are also known as ordinary shares. Then preference shares. According to section 85 of the Companies Act 1956, a preference share is one which fulfills any of the following conditions. That is, it carries a preference right of dividend to be paid either as a fixed amount payable to the preference shareholders or on the amount calculated by fixed right on the nominal value of each share before making any payment to the equity shareholders. Then the second preference is that in the event of winding up of the company, that is the company is coming to an end, the preference shareholders has the right to repayment of the capital before anything is paid to the equity shareholders. Then equity shares. According to the section 85 of the Companies Act 1956, an equity share is one which is not a preference share. In other words, the shares that does not enjoy preferential right in the payment of dividend or in the repayment of capital is known as the equity share. Share, the share is the amount that a person invests in a company. Then issue of shares. Issue of shares means when the company is in need of money, the company will issue shares. That is, company will invite the public to invest in the company. That is meant by issue of shares. There are several steps in the issue of shares. The first step is about the issue of prospectus. The company first issues the prospectus to the public that the prospectus is an invitation to the public that the new company come into existence and it needs some fund for doing the business. It contains complete information about the company and the manner in which the money is to be collected from the prospective investors. Prospective investors are the persons who invest in the company or provide share in the company. Then second step is with respect to receipt of applications. When the prospectus is issued to the public, prospective investors intending to subscribe to the capital, that is, subscribe capital means they will say that they will buy this much shares, that is subscription of capital. Subscribe the capital of the company would make an application along with the application money. So they will make a consent to a company that they will subscribe to this much shares and they have to make an application for this, and also with that application they have to pay the application money and deposit that application money with a scheduled bank as specified in the prospectus. Then the company has to get a minimum subscription. They have to get a minimum subscription from the public from the date of issue of prospectus. If the company fails to receive the same, that is minimum subscription, within the said period, that is the company cannot proceed for the allotment of shares. That is, company will give its shares. Giving shares means the company will give a document to the shareholders. Shareholders are the persons who invest money in the company. Allotment of shares and application money to be received should be returned within 130 days of the issue of prospectus. The company has to get the minimum subscription within 120 days from the issue of prospectus. Then if the company cannot proceed with the allotment of shares, they have to return the application money within 130 days of the issue of prospectus. Then the last step is about the allotment of shares. If the minimum subscription has been received, the company may proceed with the allotment of shares after fulfilling certain Legal formalities. Letters of allotment are sent to those whose shares have been allotted, and letters to regret to those whom was not allotment is made due to some reasons. When allotment is made, it results in a valid contract between the company and the applicants who become the shareholders of the company. Then the accounting treatment. When the application amount is received by the company, the accounting treatment is bank account debited to share application account. Then its narration is amount received on application of this much shares for dash per share. That is, if the company is getting, if the application amount is received for 100 shares, rupees 10 per share, then it's written like this. On allotment, when minimum subscription has been received, the company will proceed with the allotment of the shares. Then the allotment accounting procedure is for transfer of application money. That is, the company got the application money, and the application money the company transfers it into its share capital. So the accounting treatment is share capital account debited to share capital, share application account debited to share capital account. The narration is application money on shares allotted transferred to share capital. For money refunded on rejected application, if there is any rejected application, the amount has to be given back to the applicants. Then the accounting treatment is share application account debited to bank account. We are giving back the money. That is why the bank account is credited. Usually bank account carries, when received the money, bank account carries a debit balance, and if the amount goes out, it carries a credit balance. For amount due on allotment, if there is an allotment, money is due or required to be paid on allotment, then the journal entry is share allotment account debited to share capital. Then for adjustment of excess application money, if there is an excess application money, its adjustment has to be made by passing the journal entry share application account debited to share allotment account. Then for receipt of allotment money, where the company is getting the allotment money, bank account debited to share allotment account. Then if when a combined account is maintained, the journal entry is maintained in this order, like for the receipt of application and allotment account, allotment money, bank account debited to share application and share allotment account. Then for the transfer of, then after getting the receipt of the application money and allotment money, and then it is transferred to share capital account. Then the journal entry is share application account, share application and allotment account debited to share capital account. Then for the money refunded on rejected applications, that is the amount is given back. Share application account debited and share allotment account debited to bank account. Then on receipt of the allotment amount, bank account debited to share application and allotment account. Then when a call is made, that is after call is that, it is that part of the subscribed capital which has been called up on the shares. That is the that part of the amount of the subscribed capital. That is, the subscribed capital means the capital or the amount that the public is intended to pay, and that from that amount the company offers or the company calls or makes them to pay certain amount. That is meant by calls. Calls may be first call, second call and final call. Then the accounting treatment is for the amount call money due, share call account debited to share capital account. Then if the money is collected on call amount, bank account debited to share call account. That's all for today. We'll discuss the problems in the next class. Thank you.